Hi, I'm Tom Selzer from Livewire, and today I'm joined by Anthony from Milford to discuss the Milford Corporate Bond Plus Fund. Anthony, thanks for joining us.
Thanks for having me.
Anthony, do you mind just giving us a quick overview of Milford and the Milford Corporate Bond Plus Fund, please?
Milford is a New Zealand-based asset manager. We're based in Auckland. We come from very humble beginnings. So our first office in 2003 was opened above a takeaway food store. From there, we've grown to $33 billion under management. We're defined by three key philosophies. So firstly, we have a strong belief in active management. So despite being a New Zealand asset manager, we are one of the most active investors in Australia across the fixed income and equity markets. The second philosophy is we invest alongside our clients. All of our personal savings are invested in the firm or the firm's products and its funds. And so our success depends wholly on our clients' success. And then the third of those is that we're independent, we're employee owned, and we have a strong belief in staying that way. In terms of the Corporate Bond Plus Fund, it is a liquid investment grade strategy that's focused on the Australian corporate bond market. We target the highest quality issuers, and we aim to create a steady stream of income for our investors with low volatility. At the end of the day, it is focused on the liquid parts of the fixed income market, and we avoid the private and less liquid parts of the fixed income market for deliberate reasons.
And how would you say your bond strategy differs from other managers in the market?
So as I mentioned, there's a strong belief on the most liquid parts of the market, generating the strongest risk-adjusted returns in our eyes. But we have various alpha levers at our disposal to try and generate alpha above the benchmark. So the first of these is interest rate duration positioning. We take a view on where the economy is heading, and then we try to capitalize by positioning the fund's interest rate duration in a certain way, either being long or short duration, or playing different parts of the interest rate curve. Secondly, we try to position the fund in terms of credit duration to try and generate alpha. So we take a look at the premium that's offered by credit spreads in the market, and we can also, in a similar way to interest rate duration, position the fund long or short credit duration versus the benchmark. And then once we've figured out the interest rate and credit duration positioning of the fund, we then look at asset allocation. And asset allocation can take multiple forms. For example, we can invest across currencies. The fund is predominantly an Aussie dollar corporate bond focused fund, but it has the flexibility to invest in the euro and US dollar bond issuances from Australian companies that have issued offshore. Asset allocation can also mean looking at different parts of the fixed income market. So we're not just constrained to the corporate bond market per se, but we can look at adjacent sectors such as the mortgage-backed security market, and we can also look at government and government-related sectors. So there's many different alpha tools at our disposal, and we're not dependent on any one of those levers to generate alpha for our clients.
You mentioned it there. I think you guys are mostly invested in AUD-denominated securities. What's the outlook for the market there at the moment?
As I look at it right now, it's quite simple, really. So the Australian corporate bond market is averaging yields anywhere between 4 to 5%. Our fund right now, the average yield is about 5%. So if you just look at that yield in isolation, it's at a fairly attractive level in its own right, but it's also at a fairly attractive level compared to other asset classes. And also when we compare it to history, the current level of yields is also at a very attractive level as well. That level of yield provides a strong buffer against potential future market volatility. If I look more deeply at the market and look at the fundamentals underlying the market, the situation looks quite healthy. If we look at corporate balance sheets, corporate leverage amongst corporate borrowers in Australia has not really materially increased over, say, the past 5 to 10 years. We look at corporate mergers and acquisition plans and investment plans. Those levels of investment activity are sitting at fairly modest and healthy levels. And that means from a bond investor's point of view, there's less supply of bonds that have to hit the market to fund these investment plans. The second thing I'd point out is that the banking sector in Australia, which is kind of the bedrock of the credit market here, the banking sector is in extremely good shape. Over the past decade and a half since the financial crisis, they've increased their capital levels by upwards of 50%. They're very profitable organisations, and they're profitable for a number of reasons. But at the end of the day, a profitable banking sector means a healthy credit market in general. And it's a sector that is willing and able to lend to corporates and households across the country. And then finally, if we look at households themselves, the unemployment rate in Australia is fairly low. And when you have low unemployment, that means low mortgage default rates, and then it comes back to a healthy banking system that is willing and able to lend to the Australian economy.
And diving a bit deeper into your funds, I think the Corporate Bond Plus fund looks to offer regular income and low volatility. How are you going about achieving those outcomes?
Through several ways. First and foremost, we invest in the most high quality issuers in the Australian corporate bond market. And that means we're investing in companies like the large banks, utilities, infrastructure owners, and owners of real estate. And the key kind of thread that kind of binds these sectors together is that these issuers all have strong regulatory contexts in which they operate. They generate long-dated, contracted or regulated cash flows, and they have stable capital structures and low amounts of leverage. So we're quite happy to have that as the underpinnings of our portfolio. The second way we kind of manage volatility is to look at hedging instruments. We employ a number of hedging tools. So for example, to hedge interest rate risk, we can use interest rate swaps, bond options, bond futures to try and manage interest rate volatility. If we're trying to manage credit risk, we can look at things like credit default swaps and credit options to manage that credit volatility. At the end of the day, we're agnostic in terms of what hedging instruments that we use, and it really depends on our market outlook and what we see as the most cost-effective way to manage downside in the portfolio. And then the final thing, this is a strategy that's focused on the liquid parts of the fixed income market. And when you put it together, we're investing in liquid instruments of high quality issuers. And it gives us a lot of confidence that at the end of the day, if we do need to reduce and reposition our risk, we can do so in a very cost-effective and quick manner.
And what role do you think the Milford Corporate Bond Plus fund can play in an investor's portfolio?
The Corporate Bond Plus fund is designed to provide low volatility income for investors. I've mentioned it before, but the current level of interest rates, of yields across the corporate bond landscape and our fund is at fairly historically attractive levels. And that provides a strong buffer for potential market volatility that may occur in either stocks or other parts of the fixed income market or other asset classes. So I think that's the first kind of thing to highlight. The other thing I'd highlight is that the design of fixed income funds is that when the economy softens or the outlook becomes more murky, typically interest rates fall. And so when interest rates fall, you typically have capital gains for bond investors. That typically provides a portfolio stabilization function within a diversified investor portfolio. So the way we look at it is the fund itself, during good times, it provides right now very good levels of yield and income for investors. And during bad times, it can be a portfolio stabilizer and provide capital gains, which other risk assets may not.
Where are you seeing the risks in the corporate bond market at the moment, and how are you maybe mitigating against those?
There's a few risks that we see. I think first of all, in the Australian corporate bond market has grown enormously in the last few years for a number of reasons. But one of the reasons we've seen is there's been a lot of offshore inflows into our market, and that's been great. It's increased the diversity of opportunities and participants in the market, and it's created a very rich environment for active investing. But what it also entails is that there's been a fair amount of hot money that has come into the Australian corporate bond market. And some of that hot money has caused distortions in market valuations in parts of the bond market. And there's a risk if the macro settings change or the outlook changes that some of that hot money can flow out very quickly, just as quickly as it came into our market. So as an active investor, one of the ways we try to manage that risk is to basically identify which areas are facing the highest distortions because of that hot money inflows, and actively avoiding those sectors that we think are at greatest risk of subsequent outflows. Another risk that we see in the market is potentially supply indigestion. So parts of the credit market in Australia have grown rapidly in terms of the number of instruments that can be invested in. For example, in the past 12 months, we've seen a lot of growth in the mortgage-backed security market, and that's been a very solid market over the last couple of years. But it's grown rapidly to support the growth of the non-bank lending sector. As a result, the universe and supply of mortgage-backed security has grown quite rapidly in Australia, and there's some evidence that there's a little bit of supply indigestion. As a result, there's been a bit of cheapening in the valuations of those bonds in those sectors. So I think supply is something that we're monitoring, but right now, things as a whole for the corporate bond market is fairly manageable.
And finally, where can investors get more information about the fund?
We have offices across the eastern seaboard, so Brisbane, Sydney and Melbourne. So if you'd like more information, please feel free to reach out to either myself or our team of business development managers, and we'd be happy to provide you with more information.
Anthony, thanks for joining us.
Thank you.
Thanks for watching. For more great videos, make sure to check out the Livewire YouTube channel.